I got an interesting question from somebody that I totally overlooked, but I want to answer that question by just kind of talking about how, in all actuality, the stock market is one big game. So if you like games where you have to match wits with some other people, then yeah, the stock market is definitely for you. Let's first get to this question I got on YouTube and one of my other just 101 videos, which I love. I enjoy when people are asking questions, and sometimes these questions, I'll just answer, but other times I'll make a video of it. So here we are. So this one question kind of just evolved into just wanting to kind of map out how the game of the stock market works. So let's get to this question first. So Caleb01 asks, I have a question about stocks. If I buy a stock in like Apple, can I sell that stock at any time, or does someone have to want to buy that stock from me? So to best illustrate this, let's just break down the market to what's actually going on and kind of break down the game as it is. Now, before I go any further, when I say game, this is a very serious game. The smartest people in the world are a part of this game. And it's not like a video game where like, oh, things didn't quite go my way, reset. It's not like a board game where you're like, oh, things didn't quite go my way. All right, let's clear off the pieces. Let's just start over. In this game, there's real money on the line. And I don't say that to try to steer you off. I'm just letting you know that using the word game, I don't want to create any sort of false pretenses. This is a very, very serious game where if you want to get involved in it, you have to put up your own hard-earned money. But how is the game played? And to kind of talk about the question of well, how long can I sell, or does somebody else have to be willing to buy my shares? So the first thing here is Apple. So that is going to represent Apple stock, AAPL, known as the ticker symbol. And in this market, we have two people. We have Billy Bob over here, and then we have Sally Sue. Now, the first distinction I want to make is Billy Bob is looking to buy. He does not own any Apple stock, but he would like to get some. Sally Sue is looking to sell her Apple stock, meaning she already owns some. So the big thing here is, and the big question that both people are asking themselves goes as follows. Billy Bob wants to know, so his big question is revolving around higher. Meaning, do I think Apple is going to go higher? Let's actually assign a price to this so we can, so let's just say Apple's trading for $50. So the big question on Billy Bob's mind is, do I think Apple is going to go higher than $50? Because obviously, if he thinks it's going to go lower, why would he buy at $50? He'll just wait for the price to go lower to that price. On the flip side of things, for Sally Sue, the big question in her mind is it going to head lower? Meaning, is $50, is this as high as it's going to get? Is it now going to start to go lower? Because if it is going to start to go lower, then Sally Sue would want to sell. Because why would she want to sell lower? Why would she want to sell at 47 when she could sell it right now for 50? So on the seller side, that is the big question just in their mind. Is it going to go lower? Is it going to go lower? Because if it is, I might as well just get out right now. On the flip side, the buyer side, they want to know, is it going to go higher? Now let's take this question a little bit deeper. Because as Caleb asked in the question, does somebody need to be there in order to buy my stock? Absolutely. So let's just say that in our case, we've already established Sally Sue. She owns it already because she is the one that wants to sell it. But if Billy Bob just does not exist, so let's just say there's an X here because Billy Bob no longer exists, and there's nobody else, then no, Sally Sue cannot sell because there is no buyer for her shares. In other words, Sally Sue made a bad decision in the first place to buy because now it's reached a point where she can't even sell it. So she's stuck and, in an example, maybe the company's gone bankrupt and there's nobody out there that wants it because the company's just a steaming pile of garbage. So why would anybody want to buy stock in the company? So Sally Sue, she is stuck. So to answer that question, and yes, there always has to be a buyer if you want to sell. Just like we're going to flip things up. So let's say Billy Bob wants to buy, but Sally Sue is not over here. She's thinking, heck no. Apple is doing great things. They are just skyrocketing, skyrocketing, skyrocketing. I don't want to sell. Well, then you know what? Billy Bob, he's just sitting out in the cold. He cannot get a part of it because nobody wants to sell. Now, of course, in the market, there's more than just two people, but this is just to illustrate what's going on in the broader sense. So, point here, in the market, there's always a buyer and a seller. There's always people that are looking at the same thing. And that's where the big game comes into play. When I say looking, these people, this is their vision. These are not like laser beams. This is like Cyclops from X, never mind. So they're both looking at the same thing. But the game is who's going to be right. Every transaction, somebody is right, somebody's wrong. Because let's just say that Sally Sue says, you know what? I think it is going to go lower. I think it is going to go below 50, so I want to sell. So, and of course, Billy's saying, I think it's going to go higher than 50, so I want to buy right now at 50. So the transaction happens. And then let's just say, so ... 57. So in this quote-unquote game that they were both looking at, who won? Well, Billy Bob won, right? Because he got Sally Sue to sell at $50, and now it's at $57. So he made a good decision to buy at 50. She made a bad decision to sell at 50 because if she'd have just waited, she could have gotten that much more money from it. Let's say that, so that happens, and now it's at 30. Who won in this game, in this transaction, as it would be called in the market? Well, Sally Sue definitely did very well. I mean, she was right. Yeah, it went lower, so she was able to sell at 50, and poor Billy Bob thought it was going higher, but he was wrong, and now it's selling for $30, meaning he is going to be losing money on the transaction. And then this is what gets interesting, is these little dots here. This could be minutes. So, I mean, maybe you've heard of the term day trader. A day trader is going to be trying to think, do I think Apple's going to go higher in like the next few minutes? This could be weeks. This would be known as swing trading. Maybe you've heard that term, a swing trader. A swing trader is thinking, do I think Apple's going to be higher, in the next couple of weeks than 50? This could be 40 years. This would be investing, those that are retiring for investing, meaning Billy Bob's going to say, I'm trying to build a retirement portfolio. Do I think Apple is going to be higher than $50 40 years from now? That's the question that he's going to be asking himself. And the very interesting aspect here is it can be mismatched, meaning you could have a day trader over here. So Sally could be a day trader, and she could be interacting with an investor. So it's not like a day trader and a day trader have to go together, or a swing trader and have to go together. It's just a big mishmash of things, and that just adds that much more complexity to the game. But that, at the core, is what the stock market is. You're competing against somebody else. Somebody's going to be right. Somebody's going to be wrong. And that's, you're matching wits. Two people looking at things, but this assumes also, and that's kind of what triggered this idea, is that there are buyers and sellers. I mean, maybe you've seen penny stocks. Penny stocks are risky in the sense of, if you're not careful, you could buy something, and then you turn into Sally Sue, and then all the buyers disappear, and you're literally stuck, in terminology, holding the bag, meaning, I own these shares, and I can't sell them to anybody. So you got to be careful of that. But most stocks, I mean, if you're talking Apple or any of the big blue chip companies, yeah, you're always going to be able to find a seller. You're always going to be able to find a buyer. But what it does after you buy or after it sells, hey, that's the name of the game. That's what makes people either good investors or bad investors. That's what makes people good traders or bad traders. And that's what the whole market revolves around, and what determines whether or not you're going to be successful or not. Because if you're always buying at prices and then it's always going down, well, your money's not going to last very long. Because I started with this, I'll end with this, there is no reset button. So game, I'm not saying you should treat it like a game or, hey, let's just have a good time. No, this is a very serious business. But from a game mentality, in terms of you're always competing against somebody else, you're always trying to match wits with somebody else, that's how it is actually, functions as a game. So hopefully this helps out again. And I have other videos how the stock market works, more so how a transaction works. How the stock market as a whole is a game. Hopefully this does a good job of illustrating that. But that's what it all boils down to. You have a buyer, you have a seller, you have a stock in the middle. Somebody wants it to go higher. Somebody thinks it's going to be going lower. And somebody's right and somebody's wrong. It's really I don't want to say as easy as that, but that's the core foundation of what's going on in every single transaction in the market.